Because the last thing you want to ever do is get a call that someone has passed away and you look at your file and you didn't do right by them, but you got a commission.
Do you think that IULs are the better option than a whole life policy for becoming your own banker?
No one wants to look at your online banking and say, well, it says $10,000 a day, but tonight it may be 90.
Yeah.
That's a problem.
But many people prefer 401ks over infinite banking policies because of the company match. So they say, it's free money. So what are your thoughts on that? And do you really think that it's free money?
Because once I get in front of you, we're going to educate you and you're going to understand how this works and why it benefits you. So if you say, hey, this bank is going to be for my child's X, this is going to be for my retirement. So you set them up on different time frames. So when those different milestones happen in your life, you know what bank to access.
Right. I just love this. If someone faces legal issues like debt, bankruptcy, or child support issues, can their money be taken from their infinite banking policy like it can be with other possessions that they may own? So why would someone not have to pay taxes on these type of policies? So I'm super excited for today's episode. So from what I see, you are a true leader in the community, serving on various nonprofit boards, and you have an impressive 19 years of experience as a financial professional. You've made it your mission to help businesses and individuals by educating, organizing, and preparing them for financial challenges that are bound to come up. So I want to know, can you share what inspired you to become a financial professional?
All right. Well, first of all, thanks for having me. It's truly an honor to be here with you guys today. I wasn't looking to be in the financial industry, truth be told. So I was playing basketball. I was playing professional basketball overseas in Iceland. So we had just got back into the country. I had a wife and a child. So I'm like, I got to get a job.
Yeah.
And so I put my resume out there, and only people that called me back were these financial services companies. I'm like, okay. So I went to an interview, and what got to me was this. The guy said, "Is no limit on your income. It's all based on how hard you could work." And that sold me. And what it sold me on was, no one's going to outwork me. I can control my own income. As long as I work hard, sign me up.
Wow. That's a little different because for me, when you're first starting to go and get a job, that to me sounds scary at that time because it's like, it's all dependent on me. There's no guarantee. So to see that you was already mentally prepared for basically entrepreneurship.
Well, athletics, I give credit to athletics for that, because in athletics, you have to compete each time out. You can't worry about what you did last week or last year. You got to constantly perform each day. So you got to keep yourself level. And so I understood I couldn't get too high or too low. Yeah. Just keep working, stay consistent.
Yeah, that's important. I like that. So athletes, they got a leg up when it comes to entrepreneurship.
I like to think so.
I think so, kind of, sort of. So infinite banking before COVID wasn't well known as it is today, right? So because of the misconceptions, a lot of people, they feel like infinite banking is a scam because of overfunding your insurance policy to build cash value. So some will say it's only a refund of your money. So I want to ask you, is infinite banking a scam, and is the cash value only a refund?
Infinite banking is not a scam.
Right.
Prior to being named infinite banking, we used to call it overfunding, or SLRP, Simplified Life Insurance Retirement Plan. And I heard of that back in 05, 06. That's when I first was introduced to this concept. What it is you're putting money into your policy above your premium, and it's the insurance companies will give you a limit that you can put in there. So it's not called a modified endowment contract. Right. So it's not considered an investment. And so once you put that money in, it's above what you're putting in there. And then when you're with a great company that's going to pay you a dividend, so it's more than just a refund. It's not a refund of your money. It's going to perform well, and you're able to reap the benefits of it.
Right. And you say a good company that's going to pay you a dividend, right? Yeah. So we know it's not a scam, but you get paid dividends, just like someone that put their money into stocks, right?
That's absolutely right.
But insurance, you get to get a dividend.
Get a dividend.
So what is a dividend for people that may not understand what a dividend truly is.
All right. A dividend is when the company does well financially, they share it with the owners, i.e. a mutual company. So you have a numerous of mutual companies. I'm not going to name them all, but you know the ones that, right. And so a mutual company that's performing well, they're going to give you a dividend, and you can either take it, put it back into your policy, or you can you take a check, take the money. But most people, I recommend putting it back into your policy.
Right. So when they put it back into their policy, what does it do when they basically reinvest the dividend back into the policy?
It grows. It grows.
How much does it grow?
Some dividends are giving you 6%. Some are giving you 5.25%. It just depends on what the dividend scale is going to be. But that's something you can find out before you sign up for the policy.
Right. And now I might be going a little too deep, but I do want to say this. So I'm going to ask you, when you invest the dividend back into the policy, right, what does it equate to? Like, it comes back in the form, or you'll see it in the form of what, like the cash value? Like, what does that equate?
You're going to see the dividends in your cash value. So when you look at your policy, you have your death benefit, your cash value is going to increase. And you say, oh, wow, it increased by this much.
Right.
And you can see it'll break down on the illustration. These are your dividends and so forth.
Right.
And you can see that.
Right.
And can I take it a step further?
Yeah.
With a lot of my retirees, it's like, hey, I want to retire. I really don't want to pay the premium. Their dividend is large enough to cover their premium. So you can use that to offset premium if the policy been enforced for a good little while.
So you can, that's a great to know, because a lot of people don't know that. And it'll save them money, actually.
Absolutely. Put money back into their pocket.
Yeah, without, hey, you're just going to use the dividend instead of the money that's in your pocket.
Right.
So that's good. Also, I do recognize that the dividend actually grows the death benefit as well, right?
Yeah, absolutely. The death benefit is going to increase as well. And also, remember this is all tax-free money.
Right.
So you're not going to pay taxes on life insurance.
Right.
That's the beauty of it.
So why would someone not have to pay taxes on these type of policies?
Because life insurance is not considered an investment, and it's after-tax dollars that is going into the policy. And so because of that, the IRS is not going to tax it. If you look at corporations, they buy life insurance by the boatload because they understand the benefits of it.
Yes, indeed, they sure do. This brings me to my next question. So with infinite banking, you can't just use any product, right? You got to have a well-structured whole life policy. But I'm seeing a lot of people believe that the best products are index universal life policies, IULs, because of the potential high returns and the 0% floor of them not losing money. So do you think that IULs are the better option than a whole life policy for becoming your own banker?
Personally, no. And this is my reason why. Most IULs are not properly funded. And so what happens is people will pay this. Perfect example, a 40-year-old wants $1 million worth of life insurance and they want a permanent policy. Well, it's going to probably cost anywhere from $300 to $500 a month, let's say.
Right.
Well, with an IUL, you can get it for a lot cheaper. But you don't cover the cost of insurance. So as time goes on, the policy is not going to perform because too much money is going to the cost of insurance.
Right.
And so then you're going to have a problem.
Right.
And that's the issue I have with the index. I know you have a lot of people on social media that love it and swear by it. Personally, I want to make sure when I sell a product that it's going to perform, and I'm not worried about the what ifs.
Right.
What if this company doesn't do what they're supposed to? So that's why I like a whole life, because a whole life you have guarantees. That's the only product where we can say guarantee, because with the IUL, you can't say guarantee. With a variable universal life, you can't say guarantee. But with a whole life, the cash value is guaranteed.
Right. And so when you say guarantee, because they be like, what does that mean? When you say the whole life is guaranteed, IULs are not guaranteed.
Right.
What does that mean?
Give some clarity on that. You can get an IUL and have the death benefit guaranteed. So if your death benefit is $100,000, they'll give you $100,000.
Right.
But your cash value is not guaranteed.
Right.
So with a whole life, if you have $20,000 of cash value built in, it's guaranteed, regardless of what happens to the stock market, what happens to the policy. If it's not performing, once you have that number, it's guaranteed.
Right. That's good.
Being an entrepreneur is so hard. There's always a new problem that you need to solve within your business, and it's always rooted to how can I make more money so that I can grow my business. But trust me, I know it's hard because of the many hats that you wear within your business every single day. I've helped countless business owners to solve this very problem with what I call profit, cash flow, and revenue drivers. These 3 key drivers are major to make your business move. This is truly the cheat code to making more money within your business. And if you see this working for you, schedule a call with me today by clicking the link below, within the description, or the comments. See you there.
Okay, so we understand that with a properly structured whole life policy that's built for infinite banking, it not only provides guaranteed growth, right? But you also receive dividends. Now, do clients receive dividends with an IUL?
No.
Right. And so why don't they receive dividends with an IUL?
It's not designed that way. And the product is not designed to give dividends. The IUL, the biggest thing about IUL is the flexible premium. So I can adjust the premium down or up to fit my budget. And that's why people sell an IUL, I think, is to be able to give you some sense of a permanent policy, but it's really not like a permanent policy.
Right. Because, it's not guaranteed. The unfortunate part is so many people, because they're not educated in whole life insurance and what it means to really become your own banker, they just go with it.
Right. And whole life costs more. Let's be clear about that.
Yeah.
It does cost more, but the benefit outweighs it.
Yes.
And so you got to ask yourself, do I want quantity or do I want quality?
Right. Seriously, that's a good question. I think that will solve a lot of problems. Once you get educated on something, now you know, okay, no, I don't need this, or this is not what I'm looking for. This is what I'm looking for.
Absolutely.
So my husband and I, we've been using infinite banking for the last 5 years, right? So we've noticed that no matter how the market has turned, whether it was stocks, real estate, or crypto, our banking system still grew even when the market was down. So can someone that have an index universal life policy receive the same benefit?
Not at all. Whole lives are not tied to the market. So those real estate, crypto, or the stocks and bonds, it has no bearing on that policy. Unlike with an IUL, it can have an effect on it. And so when it goes down, you can see your policy go down.
Right. Exactly.
Once again, it's not guaranteed, unlike a whole life cash value is.
Right. That's the whole purpose of becoming your own banker, because you want it guaranteed. You want to be able to pull money out, right?
You want to be able to count on it.
Right.
No one wants to look at your online banking and say, well, it says $10,000 a day, but tonight it may be 90.
Yeah.
That's a problem.
For real, I'll be upset.
Right. We're calling the bank, you know.
Yes, exactly. So this is a little different. But many people prefer 401ks over infinite banking policies because of the company match. So they say, it's free money. So what are your thoughts on that? And do you really think that it's free money?
No, it's no such thing as free money in the United States of America. Okay. Because when you say free money, what they mean is this: the company is going to match me up to 3%. So if I put 3%, they're going to match me up to 3%.
Right.
Understand this: the 401k, you got to understand the history of it. The 401k was designed because corporations said, hey, we can't give these employees pension plans anymore because it's too expensive. So in the IRS code, they created the 401k plan, which allows the business owner to get a tax deduction when they match their employers. So they're not doing this out the kindness of their heart. They get a benefit.
Yes.
So perfect example, if you have someone that has $100,000 in their 401k and you have $100,000 in your cash value whole life policy, when you go to retire, you're going to pay about 30% in taxes on that 401k.
Right.
So right there, you have about $70,000.
Right.
Whereas with your whole life, it's $100,000. You've already paid taxes.
Right.
So I understand both arguments. I always tell people it's based on your situation.
Right.
Not all shoe size fit everyone. So you have to really look at why would I do this or why wouldn't I do this? But understand, it's not free money.
Right. It's not free money, because I've had clients that is over 70 years old and some that's in their 60s, and they pay taxes on these 401ks today. Yeah. And it's a hard pill for them to swallow.
And what you got to realize, when they get that income from their 401k, it puts them in a different tax bracket.
Yes, it does.
So if I'm in a 20% tax bracket, but I just took out a distribution of $70,000, now I'm in the 20. Wait a minute. So some of the credits and deductions that I was able to get, I no longer get.
Right.
So it's actually costing you a lot more than what you think.
It is. It really is. And the sad part is, you give this information and they don't understand it until it's like it takes a lot for someone to really grasp what infinite banking really is. You know, the true infinite banking, utilizing a dividend paying whole life insurance policy. So I'm seeing a lot of people prefer Roths over the 401k, the traditional 401k, because of tax benefits. But we know the maximum amount that you can contribute to a Roth as of 2024 is $7,000 annually. And your income cannot exceed $161,000. So if you're single and $240,000 is what you make, and you're married, so let's say I'm making that amount, right? The 240. Am I capped at $7,000 annually with an infinite banking policy like with Roth?
No, you're not. And also, you're not capped, so you can put as much money as you want into it. And also, keep this in mind, you have a death benefit. We haven't talked about that. We're focusing on the cash value, but the beauty in this is that when I close my eyes, my family's going to get another check that's going to continue my legacy.
Right. So, all right, I'll ask you this. So the cash value, a lot of people don't understand this. What is the cash value? What can that do for you?
So the cash value, look at it as like a living benefit. While I'm living, I can use this cash value to pay for kids' education. I can put a down payment on the house. I can buy a car. Whatever I want to do with this money, I can be able to do that. Right? And then on the flip side of it is when I close my eyes, I have a death benefit that will go to my loved ones to maintain the lifestyle that we've created.
Right. And so that's the cash value. Now, with traditional whole life insurance, how long do it take for the cash value to build? You got a traditional policy.
Yeah, a traditional policy, don't hold me to the exact time, but typically about 13 years is where I call it the break even. What you've put into it is outperforming, the cash value is outperforming what you put into it. And so from year 13 on, you're winning. You're in the positive. So you got to keep this in mind. The cost of insurance as well. That's what we're paying. So you're telling the company, if I give you $100 a month, I want you to give me $250,000. Well, they got to make sure from a business standpoint that it makes sense. And so that's why it takes that amount of time.
So 13 years now with infinite banking, from what I've seen, you could break even in year 5, year 6.
Absolutely. You can break even a lot faster because you're putting more money into it.
Right.
And so the additional money that you put into it, it goes directly to the cash value.
Right.
So it grows a lot faster.
Right.
Whereas when a traditional whole life policy, it takes a little longer to really start to grow.
And then from what I've seen too, it like traditional, sometimes it takes up to 2 to 3 years for you to start even seeing cash value in the policy.
That is true.
Like, that's crazy to me. All this money you've put in, let's say you pay $100 a month, that's $1,200 a year, $2,400, and it's hardly nothing in there.
Yeah.
You know, so if you can't make your payment one day, you done for.
Yeah, right.
I mean, you know, unless you got enough cash value to cover the premium.
Right.
So with Roth IRAs and 401ks, there are certain requirements you have to meet to pull money from them, right? So with infinite banking, how long do I have to wait to borrow money from my banking system? And do I have to meet any requirements to borrow from it?
All right. There's no requirements you have to meet to be able to borrow from it. And you can borrow as soon as we see the cash value. So it's really based on how quick the policy is going to grow. For some people, it may take 3 years. For some, it may take 2, and so forth. So it's really based on how aggressive you are with your policy. And then I always tell my clients, let's talk about a timetable. When do you feel like you're going to need this money and for what? So we can manage expectations.
Right.
That's very important in situations like this.
Okay. So let's say if I was a client and I wanted to put in $30,000 a year, right? But the first year I need to pull out at least $15,000. Can I do that?
And for most carriers, that should not be a problem. But as someone who wants to not just sell your product, we're going to plan this out. So if we know we're going to need 15 the first year, let's look at this and let's be very strategic so you can make sure we maximize the best options for you.
I like that. So you're not just going to be like, okay, let me educate you and show you this plan.
No, for me, this is a ministry. To be able to educate people, to give them knowledge and to help them. That's what it's about to me. It's not about, I just want to make a quick sale so I can get paid.
Right.
If you do right by people, you'll get paid on the back end. I'm a firm believer in that.
Yeah. That's good, because a lot of people they want to they want to put it in, depending on what they have, like an investment or something. I get it, but I like the fact that you are strategic, like you educate them, because now you can't say you didn't know.
Right.
You know, because and then you're not just pulling out money willy nilly, and it's just going anywhere. You have a plan.
Absolutely.
So just follow it and it'll work. So I've seen celebrities like Alex Jones face significant legal issues, like being sued for that $900 million that he didn't pay, I don't think. So my question is, if someone faces legal issues like debt, bankruptcy, or child support issues, can their money be taken from their infinite banking policy like it can be with other possessions that they may own?
The easy answer is no, but what I've recently learned is that certain states have different rules. So you got to really check with your state to figure out if this is going to be considered part of your personal assets, or how is it. But now, here's another thing. If it's not in your name, if you have your policy in your trust name, that's not a part of your personal assets.
Right.
So, but I would tell you, check with your state or CPA. They should be able to tell you the laws behind that.
That is so true. The states are really different. They got their own set of laws. There's a general law, and then they got their own laws that they make.
Absolutely.
To pierce your stuff.
Yes.
You know. So if you could think of one major reason, what would be the greatest reason for someone to be their own banker?
When you become your own banker, you have control. You're not at the mercy of a lender to tell you this is going to be your payments. This is when and this is the time frame you have. When I am my own bank, I set those rules. So I'm truly in control.
Right.
And that's what you want. You want to be in control of your money. It's your money. You've earned it. You worked hard for it. Control how it goes and where it goes.
So what challenges have you faced in educating clients about the benefits and limitations of infinite banking?
To be honest, I think it's more or less getting rid of the outside noise.
Yeah.
So many times we hear things from these influencers who are not in the business and so forth, and they're giving their own opinion. So I always say, hey, do the research, get with a professional where they can walk you through and educate you. And so I don't even look at it as challenges, because once I get in front of you, we're going to educate you and you're going to understand how this works and why it benefits you.
Right. Do you find that when they come to you that they're willing to listen and learn what you're telling them? Is it hard to kind of get them to understand?
All right. Men are typically more difficult. Women are more open.
Okay.
Men feel like, I know this. You're not going to tell me nothing new. A woman is like, I don't know, so educate me. So they have a willingness there. But once you disarm the man, the brother, and he sees like, okay, this makes sense. It's fine.
So it take you a little second to
Takes a second.
Okay, I got you.
But if you look at the transfer of wealth, men, we typically transition first. And so all the wealth that we create goes to the women. And so if you look at studies, they talk about these baby boomers, women will be controlling about 87% of the wealth in the world over the next 30 years.
Wow. 87%? That's a huge number.
Yeah.
So they got to get their ducks in a row, is what you're saying.
Please.
Tell them, Pierre, they got to do what?
You gotta get yourself in order. Have a good wife.
For real. So what advice would you give someone who is hesitant about using whole life insurance as part of their wealth strategy?
I would say start small. One step at a time.
Right.
Ideally, you may want to do X, but let's start small so you can get an understanding, see how it works, and get comfortable. And once you see it firsthand, they'll come to you and say, hey, I want to do more.
Right. That is so true.
Just start small. It's okay.
Yeah. And don't feel bad, because a lot of times they'll be like, well, a lot of times they'll wait until later, and then later comes and like, I should have been started.
And another thing that we didn't really hit on is the health. Once you start it and you lock in your health rate at your current health rate. So if you get older and life happens and you have some health challenges, you don't have to worry about it because you already got it locked in.
Right. So what IULs, I guess you lock those in too, huh?
Yeah, you can lock the health rates in.
Okay. So if someone comes to get, a policy because they want to become their own banker, they want more control. When it comes to getting their health check and all that, that's just a one-time thing.
Yes.
They don't have to worry about that again. So can they get multiple policies after they get that one, can they add more?
It depends on what type of riders you build in. Like I like to always add the guaranteed insurability option. So that will give you the option to get more coverage when you've locked in your health. You're just going to pay whatever age you are, but your health rating is already locked in.
Yeah, see, that's important. That's why they need you, because you just said something that was really key. A lot of people don't make sure that rider is on a policy. So if that rider isn't on there, what does that mean?
That means they're going to have to reapply every time they want a new policy.
Yeah.
And so if life changes and their health is not as what it once was, you run into issues.
Yeah, they done for it.
Yeah.
And so when you get, once you get a policy, right? When you truly become your own banker, don't you want to set up like banks? So when you want multiple?
Typically, you want to be strategic with it. So if you say, hey, this bank is going to be for my child's X, this is going to be for my retirement. So you set them up on different time frames. So when those different milestones happen in your life, you know what bank to access.
Right. I just love this. It's very strategic. You know, I'm strategic with being a CFO and advisor, right? But you're strategic in insurance.
Yes.
And I think that is so important because people just do anything. But when they talk to you, you're going to provide them with everything that they need. They don't need to go nowhere else.
No, we're gonna have a lot of questions. And it's a process. This is not a one-time only. I always tell my clients, we want to build a relationship. So right now we're focusing on this, and as life evolves and things change, we're going to be there with you every step of the way.
So with continuous education for them, like not nothing formal, but how often are you communicating with your clients?
I typically like to communicate with them at least 3 to 4 times a year. Some don't want that much. Some like, I'm good, just call me. Right. But for the ones that are really hands-on, at least 3 times a year, we may try and do a quarterly meeting just to check in. Hey, this is what's going on. This is how your policy is performing.
Yeah.
Any questions? Has anything changed? Because what I found is that if you don't check on people, life happens.
Yes.
And if you're not relevant, they go with whoever's first thing in their mind. They can sometimes forget you.
Yeah.
So you got to constantly be in contact with them.
Yeah, and life changes. They, having children, adding to their family, growing their family. So they need coverage. And a lot of times they're not thinking about insurance.
No.
Not unless they're really stable. So looking back on your journey as a financial professional, what are some key lessons you learned that have shaped your approach to helping your clients?
Early in the business, I had a senior advisor tell us, don't ever put yourself before a client. So when you go in there and you're trying to, and they want certain products and so forth, you always have to make sure you do what's best for the client. Because the last thing you want to ever do is get a call that someone has passed away and you look at your file and you didn't do right by them, but you got a commission.
Yeah.
And so that's always stuck with me. So I've had clients that'll say, hey, I want to do this whole life. And I say, I want you to do the whole life. However, you got a growing family, you have this much debt, we need to do X.
Right.
And we'll go that route. And it's paid dividends because they see the value. They see, hey, this person's not just trying to think of themselves. They're really thinking about me and my family. And that's what it's about. So I take that to heart. Make sure you do what's right by the people, even if it doesn't benefit you. And most of the time, it's okay.
Yeah. You are a rare gem to come across in the insurance industry. I've been in the insurance industry for 12 years. And many agents I've come across, they are salesmen first.
No.
That's what they there for. They there for a sale. They don't care about the client. I had to go behind, previous many agents, and they've sold term policies. Clients is turning 50, 55, and it's gone. Yeah. And their health is terrible. So for someone to have someone like you, it would be a blessing for them because they really don't understand what they have. You're very rare to come across.
Thank you.
Yes, very rare. So in your experience, what is the most important financial lesson that you believe everyone should understand?
Live below your means.
Yes.
And compete with yourself and not everybody else. Too many people say, well, I have this degree, I work in this job, so I should live X, I should drive X. No. Focus on what's best for you. If you have to stay in this neighborhood and drive that vehicle to reach your financial goals, do that.
Yeah. I like that. I want to hear it again. What was the second one?
Compete with yourself.
and nobody else.
And nobody else.
Yes.
Too many times we look at social media and say, oh, they doing this, they doing it. But we don't realize when we see stuff on social media, they've probably taken 5 pictures and chosen the best one to put out there with the right angle, with the right sunlight, and so let me just focus on me.
Right.
And do what's best for me. And if you do that and you're living below your means, you'll be fine.
I think that's great advice. Live below your means and compete with yourself and nobody else. See, I remember it. That's good. So I just want to thank you for coming on today, giving us a little bit of your time to educate us about how we can, become our own banks. So again, thank you again, and we appreciate you.
Thank you for having me. I'm always available, so I'm a call away.
Okay, sounds good.